In this example video, we're going to look at review exercises 13-5, 6, 7, and 8. We're going to be looking at how we treat available for sale securities. So they tell us in review exercise 13-5 that on April 30th, our company purchased a Smith Corporation 10% 5-year bond with a face value of $12,000 at par plus 4 months of accrued interest. And we need to prepare the April 30th journal entry to record the purchase of these available for sale securities. So available for sale securities can be bonds, or they could be stocks that we're purchasing. And it's for companies that are not doing this for a living. They don't plan to hold them to maturity, but they're also not a bank or an investment firm that buys and sells investments frequently. So that's what it's kind of that catch-all for everybody else falls under the available for sale securities. So they're telling us that the price that we're actually paying for that investment is at par, which means that we're paying the face value, or in this case, the $12,000 for the actual investment. However, we're buying it in between an interest period. So we're buying it on April 30th. Their interest payments, let's assume, are on June 30th and December 31st. So somebody else has been the bondholder for those first few months of the year. So basically, we have to pay that previous person those 4 months that they've earned in interest up front, because when I actually get this semi-annual interest payment, I'm going to receive all 6 months of interest, even though I've not been the bondholder for the full 6-month period. So we're paying somebody the 4 months that they've earned up front, and we're going to basically regain that 4 months plus get our 2 months that we've earned once that first interest payment comes in. So we're going to prepare that journal entry as of April 30th. So again, this is an investment in available for sale security. And we're going to put in that we bought it for $12,000 because that's the investment that we're actually buying, the value of that investment. Again, we paid it at par value. So we have it at $12,000. We're actually going to debit our interest income account, which obviously an income account typically is going to be credited. But in fact, we're going to debit it because we want to have something that's going to be offsetting how much interest income we're going to record once we get that first interest payment, because that's going to include 6 months, and we want something to offset the 4 months because we haven't earned all 6 months because we haven't been the bondholder for that time. So $12,000 face value times this 10% annual interest rate, and we owe that previous bondholder 4 months worth of interest. That is how much they have earned. So we're going to pay them that additional $400 up front. So in total, we're going to pay $12,400 to acquire that investment on April 30th. In review exercise 13-6, it says, referring to the information above, assume that on June 30th, we receive interest on the Smith Corporation bonds, and they want us to prepare that journal entry. So June 30th, we're going to get something, and what we're going to get is cash. And again, $12,000 is the face value times the 10% annual interest rate, and they pay on a semi-annual basis, so we have to cut that total in half. So we're in total going to get $600 in cash. And now we're going to credit our interest income account for that $600. So when we think about our interest income account, if we're thinking about our ledger here, it would have had a debit of $400. We just credited it for $600, which means the balance in the interest income account as of June 30th would be $200, which would represent the 2 months that I've earned in interest, May and June. So now it's properly reflecting how much I've actually earned. In review exercise 13-7, it says, referring to the information above, assume that on December 31st, the investment in the Smith Corporation bonds has a market value of $12,300, and they want us to prepare the year-end journal entry to record what we call an unrealized gain or loss. So when we're talking about available for sale securities, again, this is for companies that have some idle cash that they want to invest to try to make a good return. This is not what their company does for a living. They're not a bank or a mutual fund company. and they're not holding on to these investments until they mature. They are readily available to be sold when and if that company needs that money. So we don't actually impact the investment account directly for what we call this unrealized gain or loss. It's unrealized because I'm not actually selling this investment. So I haven't actually gained anything and I haven't actually lost anything. It's basically what I could have gained or lost had I sold my entire investment in the Smith Corporation bonds as of December 31st. So we're going to compare the market value to the carrying value of the bonds that we have. So on December 31st, we're going to do an adjusting entry. So they told us the market value, what they're worth as of December 31st, is $12,300, and the carrying value of our bonds is $12,000. So that means we actually have what we call an unrealized gain. So what we do is we debit an account called the allowance for change in the fair value of our investment. So the difference is going to be between the market value, the $12,300, and what our carrying value is, which is the $12,000. So we have a $300 change. So the allowance for the change in fair value of an investment account kind of flip-flops between being a contra asset account and an adjunct asset account. If the fair value had dropped, that means we'd want the allowance account to be a credit, meaning a contra asset account. It would be reducing or conflicting with our investment account and bringing it down in value. In this case, we want it to be an adjunct asset account because we want it to be adding to the value of an asset. So we want it to be increasing that total. So the allowance account is going to be debited to show that our total investment value as of December 31st, our balance sheet date, would have increased by $300. And what we're going to credit is our unrealized holding gain or loss for our available for sale securities for that $300. The unrealized holding gain or loss account is actually also going to be on our balance sheet. It's going to be in that stockholder equity section of our balance sheet. So we do this adjustment. We're not directly impacting the investment account. We have an offsetting account, the allowance account. Again, it's going to either be an adjunct asset account when the market value is higher than the carrying value, or it's going to be a contra account if our fair value is less than the carrying value. And in review exercise 13.8, it says, using this information, assume that on February 1st, our company sold its investment in Smith Corporation for $12,500, and they want us to prepare the journal entries to record the sale and any adjustment to the unrealized gain or loss account. So February 1st, we need to record that we have a sale. So we're getting cash. They told us we're selling our investments for $12,500. We need to remove that investment in our available for sale securities. And it has to come off at what I put it on for. I've not adjusted that investment account except for when I purchased it. So it went on my books at $12,000. It's going to come off my books at $12,000, which means that we have a gain on the sale of our available for sale securities. And this is a realized gain. It's realized meaning that it really happened. It's in reality that this is actually a gain we're getting because we're actually selling those investments that we have. If I'm getting rid of my investments, either in total or in part, I also have to adjust our two other accounts that are affected by these investments, the allowance account and the unrealized account. So on February 1st, I need to reverse that interaction. I need to completely get rid of that $300 impact because we no longer own those investments. So we have to debit our unrealized holding gain or loss on our available for sale securities. In order to zero out that effect. And we have to credit our allowance for change in fair value of our investment for the same amount. So that again, it's reversing the impact that those investments had on both of those accounts.